Good day everyone. In this video we are going to be discussing about the algorithmic fair value gap concept. So now, what is a fair value gap? A fair value gap is a PDRA which can be seen on our chart as an inefficient delivery of price when we see price moving quickly in one direction, be it in a buy side or sell side price delivery. So definitely fair value gaps are just inefficiencies, they are imbalance. So they are always shown in our chart when price move too quickly like this. So you see, let me zoom in so you guys can be able to see what I'm talking about. So this is fair value gap. So they are always annotated on our chart or seen on our chart when we see price move too quickly and does not move too quickly in one direction without offering any third party coming into play. So they are always delineated by a displacement high and a displacement low. So now let's continue. When this inefficiency delivery in price happens, they tend to leave behind a cross price action or a gap known as displacement. So it's what I was just talking about. So this is what we terms as displacement. So fair value gap leaves displacement high, but we are going to be, let me go into a time frame that you see this actual fair value gap. This one, you see that it's a long candle, this and that. So let's take a look at the 15 minutes. Let's take a look at the 15 minutes. And do you see that? So let's refine it. So this is a clear fair value gap. So I'm going to be using that. It's because we are in the lower time frame, that's why we could not see. So this is fair value gap. When you see between three candles, one, this is the bearish candle, the bullish candle, and the third candle. Once the wicks did not meet themselves, they didn't close or intersect with each other, it creates that fair value gap, and that fair value gap is what we mark on our chart when we are trying to look for them. So why do we see fair value gap in price action? So I will explain why this fair value gap appear in price actions like this on your chart. We see fair value gap as a form of displacement when the algorithm is in an hurry to reach a particular price point or draw on liquidity by repricing too quickly as an impulse price swing when smart money or bank traders or interbank traders enters into the marketplace to hide their footprint. When we see that the market wants to quickly reprice to take out liquidities, let me use this. So this is liquidity. We have liquidity resting there. What liquidity is here? Buy stop liquidity, right? And we have another liquidity here. We have buy stop liquidities. So because there are liquidities resting here, their algorithm wants to reprice quickly to take out this liquidity. That is why this gap was created. That shows one long 15-minute candle. Mind you, in this time frame, in the 15-minute chart or any chart you are looking at, each candlestick represents the length of time they will form and be created, or the length of time they will fully form to be created. Each single candle takes 15 minutes to be formed. Regarding the sizes or the ranges, we call the size of the candle ranges. So this range was a very big range, so it overshadowed how many candles. Look at the range of this candle, 1 2 3, that is 45 minutes. So it took 45 minutes, each candle representing 50 minutes. It took 45 minutes for this candle to form down. Then look at just one candle surpassing the amount of time. So this shows the market reprice quickly in one direction to take out these buy stop liquidities resting above market structure of the 15-minute time frame. So simply, large funds trader, they use this fair value gap to place orders into the marketplace. So they use it to put volumes of order, and mind you, it also could also it's fair value gap is can also be accompanied by by another block. So what I'm trying to say is that sometimes when you see this fair value gap happen, it seeks to validate other blocks when they tend to happen. So now, for that being said, I want to just continue further. So when we see this fair value gap, we mark them like this on our chart. So now, fair value gaps can be categorized into two different types in their form of delivery. So there are two types of fair value gap. Number one, we have, for those that don't know, we have the BC, and the CB. I will just annotate this again to copy this. So we have the CB. I will explain shortly in a moment what they mean. Oops, sorry for that. Let's look for, this is it. So we have the CB. So what is a BC and what is a CB? A BC simply means the meaning of BC means buy side imbalance, sell side inefficiency. So this CB means sell side imbalance and buy side inefficiency. So now, what is CB? CB, let me just simplify what they mean. When you are looking for CB, a CB is a fair value gap that is created like this. It's a fair value gap that is created by a bullish candle. You understand? So when you see fair value gap created by this kind of bullish candle, it is called CB. It's called BC. Let me put that and delineate that. So this is BC because it created a very energetic move with a bullish candle. So a CB will be the opposite. So a CB will be something like this. Do you see this fair value gap here? This is the between the displacement of the low of this bullish candle and the high of this bearish candle. You see the wicks did not intersect each other. They didn't close. It was left open and this candle passed through very quickly like that, aggressively. So we can delineate this like the way we did that here. So you can take it from this candle down to this candle. All we know is that we are taking the major highs and the major low of that fair value gap. So let me give you an example like this also for the CB. So this will be an example for a CB. This is the fair value gap. So now we will take this as CB. So there is displacement I, and fair value gap have two types of displacement when they are forming between three candles. How many candles did I called to you now? 3 candles. First candle, the bearish candle, the candle that created the energetic move, then the third candle. So if the high and the low of the candle, it doesn't matter whether it's going to be a bearish or a bullish candle, but when you see that energetic move like this where the wicks did not intersect with each other, it forms a fair value gap. You can extend that also in time like this when you want to use them to analyze high probability trade setups. So now, this is how it's going to look like on your chart after I've delineated it for you guys. So now let's continue. So now, what is a BC? So remember, I told you about liquidity, that whenever you see price rising quickly, it's aiming to take liquidity depending on your directional bias or your order flow. So we saw there are liquidities here. We are liquidity is resting here, equal high. So we are going to take this liquidity. I'm going to mark this as buy side liquidity. I mean over here we have buy side liquidities resting there. You understand? So this CB, this fair value gap, they act like magnetic price point. It is where the algorithm is gravitated to fill it. So once they fill them up, then we can consider them to be useful again in future purpose. But I'm going to be discussing that on other on our other class lessons. So now, when you see a very energetic candle, you understand, energetic candle pressing downward or upward, just like this long candle, it delineates a inefficiency in price action. Imbalance and inefficiency is happening in these two things that I delineated here for the BC and for the CB. The same also for this place also. So now, let me do something for you very quickly. So you guys are going to see it where I'm going to extend this. Where I say we use them, we extend them to also in time. Now take a look at this. I will explain what this BC and CB2 means and how you can use them. It's very simple. It's a very, very simple ICT concept. You can use them on any chart, on any is universally applicable to any trading asset class. So for this, now we are using it on synthetic indices. For I'm just dropping this video for those guys, for a lot of you that want to see them being applied and used in synthetic indices. So it's very, very simple when you understand what the algo or the algorithm is trying to do to predict future price. So now let me delineate and extend this in time. So now you can see that I've delineated it on our chart. So now let's discuss what a BC is, which is a buy side imbalance, sell side inefficiency. So what is a BC? A BC can be seen when the algorithm offers price on a buy side delivery of orders by moving price too quickly in one direction without offering any sell side delivery in the other direction. You see, we only have one movement. No sellers came into the marketplace to be efficiently delivered price. So then this creates a gap between 3 or more candles. You know, I delineated 3 or more candles, so it created a gap between 3 or more candlestick wicks, high and low, which are displacement, and they tend to stay open and wide until the algorithm seeks to rebalance the inefficiency to offer sell side delivery for sellers to participate in the marketplace for fair value. So we like to see this place balanced. If they are not balanced, they will just stay opened. So once a fair value gap is balanced, it becomes a balanced price range. You understand? So I use this as an example to make note of what a fair value gap is. Now look at the CB. The CB, we have a CB created when the market was moving aggressively to take out sell side liquidities resting below here back into this imbalance. You see, the market came down, but it was not offered efficiently. It just balanced it a bit, not completely. So this is not a balanced price range because it was not balanced completely. Like take for instance, look at the example of the CB. It was balanced quickly. So let's just take a good look at the CB. What is a CB? A CB a CB can be seen when the algorithm offers price on a sell side. This is sell side. Do you see? On a sell side delivery of orders by moving price too quickly without offering any buy side delivery in the order side. You see, we have candles, no retracement of this candle. We just have that drop, energetic move down to take this sell side liquidity. But look what was happening. We have so many candles dropping until this last one. Then we have that CB that was created here and also was created here. So when you see that price move too quickly without offering buy side delivery in the other side, and thereby creating a gap between 3 or more candlestick wicks, like the way I said for the BC, then we should see that price or that place stay open like this. When you mark the displacement, they stay open, wide open, until the algorithm will seek to rebalance the inefficiency to offer buy side delivery for buyers to participate in the marketplace for fair value for a efficient price action delivery, or a balanced price range. So what's the balance? What I mean by a balanced price is that when you see a fair value gap that is completely balanced, traded completely closed, it is called a balanced price. You look at this. This is a balanced price range. So when the market completely closes the fair value gap and closes it, it's completely called a balanced price range. Can you see that fair value gaps are everywhere, and they are not limited to one particular chart? You can see fair value gap on the daily time frame. Let me just take a look at the daily. Now this is all what we have done in the weekly time frame. So you can see fair value gap on your daily time frames, and hold on, I'm coming. You can see fair value gap. Look at this. This is a fair value gap here. Can you see that? See all these candles dropping. We have many fair value gaps that are created here. So the algorithm will seek to push price first to take this inefficiency, and also to take all these fair value gap, or close all these fair value gap one after the other, according to the way our price is being delivered and moved. So now let's drop back to the 15 minutes chart. Where were we before? Wow, I think we were, yeah, this is where we are. Now even look at the 1 hour, we can see fair value gaps. So fair value gaps are everywhere in your chart, depending on the way you want to use them. So mostly I use higher time frame fair value gap because they tend to be stronger when they are completely balanced, as in when you have a balanced price range of the higher time frame. When I mean higher time frame, from your daily time frame, weekly time frame. Of course, if you want to be an intraday trader, you can use 1 hour, 4 hours fair value gap for you to be able to use that as an opportunity to take price higher to where you want them to be pushed. So that's what fair value gap is. But let's go down to that 15-minute chart. Yeah, yes, this is it. So now let's proceed further, and let's continue as we start discussing on about the way we can use fair value. So let's start discussing how we can use it. So now one thing again is that when fair value gap are balanced, they tend to act as something we call true support and resistance, but I'll be discussing about that. Or let's just look at this now. Look at this. When we extend this fair value gap in time, let me just delineate this for you guys. Do you see that fair value gap was balanced? It was balanced. So we have no efficiency here. So we have this balanced price range. When price trades through it, now we have a balanced fair value gap, because the CB was completely traded up even up to this point. Then price came down, and you see how here reacted as something many of you guys don't use to retail trading call support and resistance. So we call it true support and resistance, but normally it's called strong levels and weak levels. So we don't look for support and resistance, we look for weakness and strength. So whenever market is buying, when you see there's an energetic move to push price higher by the algorithm. So we call that strength. But when you see there's an energetic move to push price like this downward to a specific drawn liquidity, we call that weakness. So we have weakness level and strength level. But from looking at this time frame, if we look at the 1 hour, we observe that the market is bullish. We have a bullish algorithmic order flow. So we see that the market is creating lows, lower highs, right? So the market is bullish, creating higher highs as it's going up. So I'm just using the retail concept idea to explain it to you guys so you guys can get what I'm saying more. So let's go back to our 15-minute chart and see what we can find. Let's look for that place that we were looking at here. So now, one more thing again I would like to say is that fair value gap, there are 3 specific levels in the fair value gap. Number 1, we have the displacement I, which is here that I marked. We have the consequent encroachment, is something we call CE. So the 50% of a fair value gap, when you mark them, is called consequent encroachment. And for the other block, it's called mean threshold. So here also, in the case of this, the CB, the 50% of this CB is called consequent encroachment. So for an other block, when we get to the other block lesson, I'll be teaching on that. But a lot of you know other block is a popular PD array that many people are used to. So all these are PD arrays. Why are they called PD arrays? They are always memory location that the algorithm will always seek to remember whenever it wants to come back to rebalance. So you get the point. So these are memories. So the algorithm is creating memories. It created a memory here, then later it went back. Because the order flow is what? Bullish. So it will rather take to balance this as a balanced price range. So it completely filled it. Then as the market continue moving, do you see that the year also was balanced? This fair value gap, the 3 levels we have, we have displacement I, the consequent encroachment, and the displacement low of the fair value gap. So these 3 key levels, we always act as support, through support and resistance when you extend them in time after they have been balanced. So I think that a lot of you would have gotten what a fair value gap looks like on synthetic indices. So this is how you use them. So they are very, very powerful. And let me just show you another example. Now let me just give a clean chart. Let me clean this chart. I want to show you how fair value gap works. They tend to be stronger on a higher time frame. So let's delineate the fair value gap. So now let's use the 1 hour now. I mean let's use the 1 hour. I'll use this one. I'm not using the 15-minute chart. So let me just apply the chart annotation so you guys can see how fair value gap can be used to take entries when you want to trade take a high probability setup. When you understand your directional bias that the market is bullish. Now the market is bullish because it fails to take the lows, fails to take this low, so it keeps pressing higher for higher price. So how do you use this fair value gap as a tool whenever you want to take entry? So I'm going to be showing you what you are going to be doing with this. So now I will explain this. I'll couple you some other PD array concept I'm still later going to touch in classes, in our class lessons, so that you guys will be able to get this for yourself, and you can go back to your chart and try this also too for yourself. Okay, so now here's what I'm just talking about. Now this is our 1 hour chart. Let me zoom in for you guys to see. Yes, now we have a fair value gap. So this is a BC. Price was traded in one direction. This displacement high, displacement low, right? So here will be delineated as the 50% if we are to mark up. 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 We are to mark up that range. So here will be the 50% of that fair value gap, taking a close look at it, right? So that, let me just, oh no, so that should be the 50% of that fair value gap. Yeah, so looking at it, you will know. So you, or if you don't know how to get the 50%, just anchor your fibs from your displacement high to your displacement low. You will get the 50% equilibrium for that fair value gap. So now we have our fair value gap. It was created, price came back, and what the price do? Price balanced it completely. So after balancing it, you see you can use fair value gap to take entries. So fair value gap accompanied, I told you that fair value gap, they always tend to create or validate, they tend to validate an order block to be more high in probability when you want to trade another block. Now we have another block here, so let me just show you the other block. So we have this another block, right? So why did I use the opening price? This is the opening price. This is the bearish last down candle, the bearish price. We use the high also, but the other block, the sensitive areas are the high. For a bullish order block, the high, the opening price, and the mean threshold. That's the 50%. Why for the fair value gap, it is called consequent encroachment. It's 50%. So now this is what we're looking for. So the high, the opening price, the 50% are very sensitive. Now look at what the other block, the fair value gap, the algorithm did after balancing the fair value gap completely into our order, bullish order block. And what do we see? We have that rally. So once a fair value gap is balanced, expect if it's in a bullish scenario, when a fair value gap is completely balanced, expect that fair value gap. Once you know that you are in an underlying bullish market, expect that fair value gap to always create a low. If it's in a bearish, if it is balanced, expect it to create a high. If the market is bearish, let me look for a bearish example here. You understand what I mean. Now look at this. Do you see this? I won't delineate, but there's a fair value gap in here. Okay, let me delineate it for those that do not understand the concept and still getting used to it. Now look at that fair value gap over there. Now do you see, whenever a fair value gap is completely filled, is balanced like this, expect a high to be created. If you know that the market, we are in a underlying bearish market condition. Now do you see the market is bearish? Let me zoom out. Do you see it's bearish? It's going down. So whenever fair value gap keeps getting balanced like this, I don't want to have too many examples to not make this video too long. There's a fair value gap here, right there. So a fair value gap, the reason why it's happening, liquidities are forming inside of fair value gap. Buy side liquidities for a bearish market condition, you expect when they are completely balanced, you expect buy side liquidities to be formed. But for a bullish market condition, when market change structure after a shifting market structure, you will expect sell side liquidities after they are being balanced to be formed. Whenever you see a kind of rebalance into a fair value gap, expect liquidities to be resting there. So that's how the algo works. Look at this. Once this red candle balance this fair value gap, it became a sell side liquidity, right? Then push price up, validating another bullish order block. So that is how the fair value. And one more thing, please write this in your notes. Whenever there's a fair value gap that is opened like this, whether by CB or BC, it's showing and telling you that liquidity has not been invited into that fair value gap. there's no liquidity whenever a fair value gap is open. So when the algorithm remembers, it goes there to reinvite liquidities into the marketplace, like this and like this here in the case of this, and like also this. So that will be all for now. I hope this video is insightful to you all, and if you have any questions, you can post your questions in the comment below, and the link below, through our Telegram and private discussion class. So I'll be posting the link below in this video if you guys want to join. So any question you have, just feel free to ask me, and I'll be able to look into it and give you a nice review about it. So until then, take care, bye bye, and be safe.